It is episode 129, the QBI phase out and sole proprietor versus S Corp. This is the 39.6 Facebook and YouTube Live Finance Show, your daily finance show that teaches high earners like yourselves how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, paying for college, paying for childcare, and even the car you drive. Today we take another listener question from the Facebook group, 39.6 community. This question comes from Scott. I'm looking for some advice, input here. I am likely transitioning from my current W-2 position to a full-time 1099 independent contractor. In terms of business structure, how do I decide whether it is best to remain a sole proprietor versus create an S Corp? I'm an anesthesiologist and would have no employees. My expected gross income would be over the phase-out limit for the Section 199A deduction. Do retirement contributions such as a solo 401k or HSA or health insurance or malpractice premium deductions, do they reduce your QBI to get under the phase-out? Any help is much appreciated. So this is like a huge question because it involves so many things. And I'll admit, like, the 199A QBI deduction is one of the biggest blind spots in my knowledge base. Much because I'm a W-2 employee and hasn't applied to me and is super complicated, and I just haven't really dug into it. But today, I did. I finally kind of sat down and tried to understand QBI better. I learned a little bit about it when I discussed Physician on Fire's tax return, because he had an excellent example of how awesome the QBI deduction actually is. That was discussed in episode number 83, so I would recommend you review that. I actually have an article here from the Journal of Accountancy. This is like a big journal, I think, in the finance space. I also want to note that Physician on Fire made this really nice other post just a few days ago called 10 Things You Should Know About the 20% QBI Deduction. I'm going to see if that one will show up here. There we go. And boom, I think you are seeing it now. Okay, so this is an excellent article. I would recommend that if you are a 1099 and considering trying to optimize this, to look into this. It's an excellent article that I've read, and it's been very helpful. Okay, so first of all, the QBI deduction, the qualified business income deduction, is a 20% deduction, not in tax, but in the amount of that income that is taxable. So for example, if you have $100,000 and it all qualified as qualified business income, you would not have to pay tax on 20% or $20,000 of that. Okay, so effectively it reduces your tax rate on that money. So if you are at the 24% tax bracket and those dollars are saved at that bracket, then you would take 24% times 80%, and that would give you 19.2%. So basically it would reduce a tax rate from 24% to 19%. That's in theory, and that's assuming that you don't get capped. But it is a gigantic tax savings for people who are business owners and can qualify for it, because this is an actual tax savings. Those brackets literally shift down. This is not a tax deferral where you are deferring tax to later and taking a tax arbitrage on the rate, hoping that you're withdrawing at a lower rate than you put it in. It is literally a tax savings that is permanent. That is super, super, super valuable. Sorry. Okay, so that's just kind of an orientation to this. Now, I'm going to go back to the other article that I had posted here, and from the Journal of Accountancy, because this will show you that there's 3 different groups, okay? Here it is. Where? Oh, sorry. Gotta pull up the right tab here. Okay, so what happens when I do stuff live and try to switch what I'm doing? Well, you know what? Let me just show you this first, okay, because this one is operational. All right, so the different tax brackets I've discussed ad nauseum, okay, before, and I'm showing it to you again here. This is the $1 to up to $1 million tax brackets graph, okay? And in this graph, it shows the different ranges, the blue zone, the yellow zone, and the red zone. And I always emphasize you want to get yourself out of the red zone. The red zone is the danger zone. It's the not happy zone. This is where you're paying very high rates of tax that if you can get out of it is ideal, because it's a huge jump from the 24% to the 32% rate. That 32% rate comes in at a $350,000 income. This is assuming you're taking the standard deduction, because the bottom axis here is adjusted gross income. So really this is a taxable income of about, and for 2020, it's about $326,000. Okay, everything above that is taxed at 32% or higher, and below you're in the yellow zone, which is the happier space to be. Interestingly enough, there's what we call a phase out, and that phase out of the QBI deduction, the Section 199A deduction, starts once you transition from the yellow zone to the red zone and continues for $100,000. So for example, from $350,000 to $450,000 of adjusted gross income, assuming you take the standard deduction, okay? So this really emphasizes the need to get out of this space. Okay, so I'm gonna close that down, and then I'm gonna try to pull this back up, the other one, and oh, it allowed me to have 3 things open. I've tried to do that before and I've never been able to do that. Go figure. Okay, so I'm going to just show the other one and turn that one off. I does not want to do that. Okay, turn that guy. Okay, well, here you go. Journal of Accountancy, and that's really small. I really need to get rid of that guy. Okay, wow, I cannot believe that it will not let me do it. One more time. Allow. Okay, here we go. There we go. So the Journal of Accountancy has this little table here and divides Section 199A deduction to 3 groups. You have Group 1, Group 2, and Group 3. People who are in Group 1, okay, people who are in Group 1 are people who are below the phase out. Getting below the phase out is key. Like, ideally, you want to get completely below the phase out. Okay, so that phase out comes in, I'd like it to stay bigger, sorry about that. If you're married, filing jointly, is $326,600 for 2020, okay, of taxable income. Now this is actually modified taxable income. This is basically it's all of your income, adjusted gross income. It does not include capital gains or dividends, and it does include all of your deductions, okay? So if you're itemizing your deductions, mortgage interest, property tax, etc., that does come off of that, okay? So you have to get your modified taxable income, so excluding basically capital gains and dividends, under $326,600. If you do, then you're in the happy zone. You are in Group 1. Then it's very simple. Your deduction okay, is 20% of your qualified business income. However, it is capped at 20% of your modified taxable income. Okay, so you check your QBI, you check your modified taxable income. Whichever one is lower, you take 20% of it. And it's like super easy. If you're in group 3, okay, these are people $100,000 above where the phase out starts. So above that transition from the 24% to the 32% tax brackets. So that would come in for 2020 at $426,000. If your income is over $426,000 or $426,600, and you are a specified service, trade, or business, SSTB. If you are a physician, a lawyer, you would be an SSTB. Okay, so unfortunately, if your taxable income is above that, $426,000, and your income is an SSTB, you do not qualify for any Section 199A deduction for that job. Now, you could have like multiple other jobs. Like you could have a side gig, and that side gig might not be an SSTB, and that one still could qualify for a Section 199A deduction, but it will be capped. It will be capped at either 20% of the QBI, which is the standard 20% of QBI that we used for Group 1 people, but it will also be capped at 50% of wages from that job. Okay, so if you don't take wages on that job, well, you won't get that QBI deduction. So you need to take some wages. So that would be a great reason to have an S Corp, or at least file as an S Corp, because then you would give yourself wages. But this does not apply to your question of being a 1099 anesthesiologist, because 1099 anesthesiologists are SSTB, Specified Service Trades Business category. So you won't be able to do that regardless. So you really have to get your income down at most, taxable income below $426,600. So if you're in that gray area, that area from 326 to 426, it gets unbelievably complicated, okay? Because you can still qualify for some of it, but not all of it. And there are different caps, okay? So there's one thing to pay attention to is that it phases out. Once you're at 326,600, you still get the full 20% of QBI, but then it goes down over the next $100,000, basically like 1% per 100,000. But that's just like one of the numbers. There's other things going on here, okay? So it takes into consideration the QBI. It also considers your W-2 wages, okay? And UBIA, which that one, unadjusted basis of qualified property. That doesn't really matter for a physician because you're a 1099 contractor. You don't really have assets. It's not like you own like buildings and other stuff. But you have to multiply it by this applicable percentage, which is the percentage within that 100% phase out period. So you have a reduction. Anyway, it's really complicated. You have this thing called the reduction ratio, and then you calculate what's called the excess amount, and you have the applicable percentage, which is 100% minus the reduction ratio. Like, I thought this was going to be like a really simple phase out, but it is not simple at all. And to make it more complicated, this S Corp W versus W-2 question becomes very relevant here in the phase out because the W-2 wages are part of the phase out calculation. Okay, so all that being said, now I'm going to get back to the question. Okay, so first of all, you had mentioned sole proprietor versus creating an S corp. So S corp is not really like a thing. You can either be an individual or you can be a corporation. And if you're an individual, you could be taxed as an S corp. And if you're a corporation, the default is like a C corp, but you could be taxed as, you could take an S election and taxed as an S corp. But usually people are asking is, should I file as a sole proprietor, okay, which could be like an LLC, that's a disregarded entity, or as an LLC with a S election so that you're taxed as an S corp. Okay, technically you don't need to have an LLC to work as a 1099 contractor. You can just file on Schedule C as a sole proprietor. You don't need an LLC to do this. Okay. Now, the expected gross income would be over the phase-out limit. Okay, so mentions gross income, so that's, I'm going to assume, is like the 1099 income from the job. It might be like, oh, I'm going to get, I don't know, $3,000 per shift, and I'm going to work 200 shifts, and that's going to be $600,000. That's going to be way over the limit. Okay. Now, do retirement contributions, HSA, health insurance, or malpractice premiums reduce your QBI to get under the phase out? So first of all, what's important to know is the question of the phase out is really taxable income first, okay? And not just all your taxable, but the modified taxable income. So you can include all of your deductions from charity, mortgage, property tax, okay? Like Physician on Fire, on his, he had this gigantic amounts of deductions from charity and solo 401k contributions. So all of those things are going to decrease your overall taxable income, okay? Whether it reduces it on Schedule A, directly on 1040, or on Schedule 1, or on Schedule C, at the end of the day, all of those things are decreasing your taxable income. So if you're like at $600,000 and let's pretend you put $57,000 into a solo 401k, then you're down to $543,000. You put in, what is it, $12,000 to an HSA, maybe it's 14. Let's just say it's 12,000. Okay, so that adds another $12,000 deduction. So that's $69,000 of deduction. And then let's pretend your health insurance is, I don't know, $2,000 a month. Okay, so now you're up to $24,000 there. And with the solo 401k at 57, and that's 70 or 81, and your HSA is 12. That's like 93,000. Let's just say you're down to from $600,000 down to $500,000. Okay, that would unfortunately still be above the limit. Now, if you add malpractice premium, so I was adding in health insurance at $2,000 a month, but malpractice, and you're an anesthesiologist, I don't know how much that is. Maybe that's $40,000. Okay, so now we can get ourselves down to like $460,000 if it's a $40,000 premium from $500,000. Okay, so now we're getting really close. Okay, but we're not quite where we want to be. So you would still not be able to qualify for it. But let's pretend now you're able to deduct a whole bunch from your house. You have a $10,000 property tax deduction because it's capped at $10,000, and you have, let's say, $1 million house, and that $1 million house has $40,000 of interest. That's another $50,000 deduction. Okay, so now we're getting there. And let's just pretend you donated $100,000 to charity. Okay, so now we're actually getting to now we're getting into the phase out range. Okay, I kind of lost track where we were. But all of those things reduce your taxable income and can get you down. What you did not mention is the cash balance pension. Okay, now, depending on how old you are, you may be able to still take out a substantial amount on a cash balance pension in addition to your solo 401k. Now, the solo 401k will probably get reduced a little bit from the $57,000, but you could maybe put in $100,000 into a cash balance pension, maybe more. Okay, so I mean, now that's incredibly powerful. In an ideal world, you would get your modified taxable income like right down to the $326,600 mark, your modified taxable income. So you could basically choose how much money you would put in to, let's say, your 401k as a pre-tax contribution to get you there. So let's pretend you take all your deductions and you're sitting at $335,000 of modified taxable income, and you need to get down like $9,000 more. You could take $9,000 more as a pre-tax 401k contribution to get you down to 326. And then you're like, well, why don't I put in the full 19,500? Or is it 19,000? Oh, 19,500 this year. Well, then you're taking out another 10,500 at the 24% bracket, which in a lot of situations, not unreasonable to do. But that $10,000 you're now taking at the $24,000 bracket, you are actually also reducing your qualified business income. So you're actually also going to lose a deduction from the QBI, that 20% deduction of the 24% bracket, which is a 5% permanent tax savings. A permanent 5% tax savings is pretty powerful. And you're saying, well, why not? But I'm not going to put money into the 401k. No, you could consider doing that last $10,500 as a Roth 401k contribution. Okay, because that would not reduce the amount of qualified business income because it is not a deduction of the business's income. And so that business income would stay there, so you still get to take advantage of the QBI. Okay, so if you're an independent contractor, this is something that to really be cognizant of, because if you're, let's say, above the phase out, you're missing out a lot. When you're in that phase out range, your marginal tax rate is actually gigantic because that QBI benefit is so powerful that every dollar you take off within that phase out is even more valuable actually than the amount of money above the phase out. In Physician on Fire's example, I mean, that marginal rate can actually bump over 50% if you're including like federal tax, state tax in addition to federal, because of that phase out of the QBI. So maximizing the QBI is super valuable. And so you have to first get your taxable income ideally down to the $326,600, but then you want to keep the QBI portion of your income as big as possible, ideally like the full $326,600. And like in an ideal situation, they both be exactly equal to each other. Okay. Now, all of those things I mentioned, retirement contributions, HSA, healthcare premiums, all those things are also deductions ultimately from your qualified business income. So the smaller you shrink that amount, the smaller that QBI deduction is, because it's only 20% of whatever's left over. So you have like your income, all these deductions, and then this is like your QBI, and only 20% of that is a tax deduction. So you want this to be as big as possible so that the 20% of it is also as big as possible. But that 20% also can't be more than 20% of your modified taxable income. So you want them to ideally be like the same. Now, going back to S Corp versus no S Corp. when you calculate qualified business income, you deduct all of those expenses that I mentioned, but you also have to deduct W-2 wages. Okay, so this threw a gigantic wrench into the tax planning once this got rolled out with like almost zero notice, like on December 20-something of what, 2017 or 16. I think it was for 20, I think it came out December 2016 for 2017, but I might be off by a whole year. So that W-2 income, so let's pretend here's your 1099 income and you decide to give yourself wages of like half of it, okay? So now the qualified business income is only that portion. So if the qualified business income is only that portion, then 20% of that is a small amount. It's half as much as it would have been if you didn't give yourself those wages. So now you've just sliced your QBI deduction in half. So that is a problem. So you have to weigh out the benefit of an S Corp for payroll tax in comparison to the benefit of the QBI deduction. Now, what's important to know is that both of these deductions are permanent tax deductions. These are not tax deferrals. Okay, so when you're a 1099 as an S Corp, you're going to pay yourself a wage and you're going to pay yourself the rest as a distribution. This is after all your expenses are paid for. So if your net business income is $300,000 and you pay yourself $150,000 as wages, you are decreasing your wages from what would have been like $300,000 down to $150,000 in terms of paying payroll tax. So that's great. You're going to save payroll tax on $150,000. But how much is that actual savings? It's only 2.9% of $150,000. I'll just round that off to 3%. So it's only going to save you $4,500. It's not a ton of money. If your income were $200,000 and then you cut that in half and give yourself $100,000 as wages and $100,000 as a distribution, that's much more meaningful because Social Security goes up to the first $137,000 roughly this year, and you would be getting rid of $37,000 of income that would have been taxed at Social Security. Social Security is taxed at 12.4%. Okay, so that's like 1/8 of the $37,000. So that's like $4,400 of Social Security. And then you also have the Medicare savings, which would be 2.9% on 100,000, which would be another $2,900. So now you're talking about like $7,000, $8,000. So that payroll tax savings can be quite meaningful once you're dipping down into saving Social Security. When you're above the Social Security wage base, $137K, you're only saving Medicare at 2.9%. And remember that the QBI deduction is saving you 20% of whatever the tax rate is that you're saving it at. So if you're saving it at 24%, it's actually a 4.8% permanent tax savings, which is more than 2.9% on Medicare. Okay. Now, so for most people, from my understanding of all of this, okay, if you are going to be keeping your taxable income less than the $326,600, okay, there's not really much benefit of having the S Corp at all because your W-2 is just decreasing your QBI deduction. Okay, but that's with an exception of if you're not, if you are able to get your W-2 wages below the Social Security wage base, then definitely that could be more valuable. But for people who are going to have wages that are above the $137,000, but your income is less than the $326,600, then I don't think an S Corp really makes sense. Once you get into the transition zone, okay, from the 326 to 426. Then it gets much more complicated because you have to deal with those two different things I was telling you about, the W-2 cap on wages, and then also just the phase-in reduction amount. So the general rule from what I've read is that the lower you are in that phase out, closer to 326, the more it makes sense to minimize your W-2 or not even have W-2 income at all. As you get toward the higher end of it, to the 426, then having more W-2 wages, having an S Corp makes sense and will save you more. But it's really complicated, and it would definitely be worth having a CPA who understands this stuff, not just any CPA, but really a CPA who understands these numbers to help you tax plan this situation in advance of like the end of the year, where you actually can adjust your numbers appropriately. If you are at $600,000 and you've done a cash balance pension, solo 401k, HSA, healthcare, malpractice, and you're at $450,000 and you're still trying to get another $125,000 down, and you may want to get and you already have your house and mortgage and property tax kicks off another $50,000 or so. You may want to decide, hey, am I going to donate money at the end of the year to my donor advised fund to get myself down to the 326,600? And then you're like, well, if I'm going to do that, because remember, you could have a marginal tax rate of about 50% in that range. You're like, well, how do I do that as tax efficiently as possible? Then you open up a donor advised fund. I should probably just do a talk on this separately, but then you find your long-term, your shares with long-term capital gains and donate those. If, assuming you're planning to potentially donate money, this would be like the most tax efficient way to do this, and get yourself down to a modified taxable income of $326,600. And then you can maximize your QBI deduction, which would be 20% of that. And that would be around $65,000. And then at the 24% tax bracket, that would save you around $15,000 of actual tax in your pocket money. So it's pretty powerful. So I covered a bajillion things, not necessarily in any logical order. But I hope that all makes sense and things you should consider. And again, like 199A is super complicated. S Corp versus sole proprietor gets complicated with this stuff. I've read multiple pages, and like there's different things in different places. I even gone into the tax forms, and even those are confusing. And even when they came out with it, there were very unclear things that people couldn't figure out, like healthcare premiums. Like if you have an S Corp and your health and your company is paying the premium, there's a portion of this. So I read something that actually then counts as extra wages from a QBI perspective to the person getting it. And then like it gets counted again on like Schedule 1. Anyway, it gets double counted. And it really hurts your QBI deduction potentially if it's as an S Corp as opposed to a sole proprietor. Really just confusing stuff. Yeah, this is an area where really having a CPA who understands what they're doing with this stuff, super valuable. But that should help you with kind of the broad strokes, big picture on how, at least how I think about this. And I could be wrong. People like David Anderson will probably tell me that I was wrong about a couple things. So if you ever listen to this, let me know. All right, that's it for, wow, that was 35 minutes. It is really late over here now. It's already tomorrow. Okay, that's it for episode number 129. And tomorrow will be episode 130. This is not legal, financial, professional, accounting, any advice. Simply my entertainment, maybe a little bit of yours. Sorry, Scott, it took me about 3 weeks to get to you, but it's a great question. Hope to get more good questions like this in the future. If you ever want your questions answered, please ask me in the group. That's the best place. And if you've asked me a question before, feel free to tag me in it again so I see it. I appreciate it. Have a great day.